Good evening. This is Ken Long at Tortoise Capital with a review of the weekend trading report for September 4th, 2017. Market is in bullish normal conditions. On an annual basis, using NDX 260, we're overbought at 100 out of 100. On a 10-day basis, using the 10-day NDX short term, we're also overbought at 92 out of 100. Looking at the market mosaic, price with respect to the 200-day moving average is green bullish at 4.91%. The slope of the 50 has improved slightly to 0.14%, although it is still yellow bearish. ADX is a very weak 6. The risk index is the 30-period moving average of the VIX divided by the 10-period. It scores 0.997 and puts us into risk-off conditions, because the threshold between risk on and risk off is 1. Take that score of 0.997, compare it to the last 5,000 trading days, compute the average and standard deviation of the look-back period. That lets us compute the risk C at minus 0.13. This is a 90-day histogram of that indicator. You can see that we got as low as minus 2 sigma, have come all the way back up to basically the zero line. This has been a favorable condition for long side swings as well as intraday volatility trading. They will continue with that basic assumption about 90 days ago that led to a really powerful upward move that was reflected in this the green portion of the histogram. In blended monthly rebalancing, you can see here the holdings going into the week ahead. We'll be looking at the current leaders and transitioning into Latin America, emerging markets in Asia, less Japan, in ETF 13, and so on for the other ETF portfolios. In ETF 2, the theoretical model remains exposed at 100%. Quick look at the blended monthly rebalancing portfolios for the 13 and 32. You see the 13 is all in the green. They're all above their 4-month moving average, that is. And then in ETF 32, only consumer staples, energy, and agriculture are below. Strength this week in U.S. technology and Russell 2000 in the ETF 13. You can see the BRICS doing well. And there was some give back here in the defensive plays like Japan, treasuries, and utilities. Strength in healthcare and, again, the technology. In ETF Max, rare earth and strategic metals, nickel, China materials, copper materials. So this may be an indication that XME is going to continue to do well. So we'll look for the metals and mining and the basic industry sectors. In the market health check, the vertical blue lines are 10, 20, and 30 days worth of look back, 40, 50, and 60 here. Horizontal red lines are support levels that were once resistance levels. You can see the market has found support at 243 like it did last time, and has made a move back up to the previous swing high at 248, where we had a doji on Friday, and we're testing it in this week ahead. Now, the increasing tension in North Korea has given some weakness in the overseas markets, and so I'll be expecting a gap down on Tuesday morning, but we'll see what we can see. So the red lines represent targets that were support previously, and which become price targets if we get weakness. So support at 243.5, 241.5, 239. If 241.5 at Z minus 3 collapses, then the target down here around 237 is next. You can see this sine wave looking curve here is the moving slope of the 30-period regression line, which is we consider that to be the health of the trend. It has been negative when it went below the zero line. You get we see the blue dots where it went below before. It fell as low as minus 0.12, which is sort of a normal downward slope. That was not panic selling, despite the two big red candle days, and has now slowly begun to improve over the last 4 to 10 days, really. But now we're going to see if 249 puts a lid on that channel, or whether we can get some breakthroughs in spite of the political fears. See the slope of the 10-period regression line and channel is up. Prices in the upper quarter of that 10-period RAF regression channel. The 30-period RAF regression channel lagged by a day is still sloping down, and we're pushing the top of that. So I'm expecting significant resistance here at 249. In the ETF regional report, all of the indexes are on buy signals, so that moves the portfolio into 100% invested, 0% cash. The globals at 60 are stronger than the S&P at 54. Inside the U.S., it is small caps, then tech, then large caps, then mid caps. The two strongest sectors are emerging markets and Latin America, 69 and 66 respectively. The two weakest sectors, U.S. large caps and mid caps. Basic materials in the S&P spiders getting crushed, as are industrials, although the upturn in metals may be a turnaround point. World market model, everything Europe is above average or exceptionally so. Mexico and emerging markets doing well. Canada lagging a bit. Brazil above average. Everything in the U.S. below average with the exception of the large caps. And again, you can see the strength in technology at 58 and then in the Dow at 56. Selected strength in Asia, but more of a mixed bag. Corporate bonds doing very well. Rebound in oil, gold, and silver. Looking at the world through the lens of the ETF2 system, we're looking at the top 30 in the database. I look for green and white as emerging strength, so home builders, China, biotech, and Taiwan, and international equity. Those that are green across the board are fully in full leadership positions, if you will. They've been at the top for a while, so that on a 10-week moving average as well as the current strength, they've been exceptional. Those that are white and then green, however, so that would be South Korea, the EMU index, and India are white and green, meaning that some of the strength is coming out of there. Again, I attribute that to geopolitical concerns. Shifting to the daily report, only a handful of auto framers testing out better than 2-1, a couple 551Ws, including our favorite Mexico. No signals and channeling and overreaction. Walmart, Travelers, Verizon, and Disney all signaling well on the auto framer, with Travelers firing a 5DD. A handful of frog quality numbers better than 3, and then both Travelers and Verizon in single digits on RSI2. Only the VIX signaling on auto framer here because of the last 4 days have been up pretty well. In the pinch and stretch, the first two columns looking at price with respect to its 30-period moving average, or the middle of the river. The ones that are in the green are more than 1 SD, better than the 30-period moving average, so they're out of the river to the north. The ones that are more than 1 sigma below that 30 are ones that are out of the river and to the south, and so you see Travelers and Nike are still at quite a distance from that longer-term fair value of the 30-period moving average. So that's either an opportunity for momentum to continue away from the 30 or a reversion to the mean place. So we are looking to frame these that are highlighted in both directions. Now the next two columns, the number 3 and number 4, we're looking at the width of the river itself, which is a reflection of the 30-period volatility. And so Nike is exceptionally stretched, so a sigma of 2.64 means that the last 30 days have been so directional that the river is exceptionally wide. But you can see that with only a handful in the green, and some of these are exceptionally wide but are still in the red, it is a telling sign that the recent volatility has been very tight. The most compressed pinch box on the other one, this is the case where the river is most tightly compressed. So these have been exceptionally sideways over the last 30 days. So Coke, U.S. Real Estate, Mexico, Pfizer, Caterpillar, etc. Now, the super pinch candidates in this section are ones that are a combination of both very compressed in terms of the width of the river, and then also the 4 regression lines that we track, the 10, the 30, the 90, and the 270, are all within a very narrow pinch box. And so this is a combination of lack of volatility and general agreement on fair value, and that is a posture for an expansive move in either direction out of the pinch box. And so we'll be framing these for exactly those kinds of breakouts, and among my most favorite patterns right now. In the auto framer, a handful test out better than 2 to 1. And in the regression line fractal framework, the top shelf, these in the green, are the most ATR below their own RL270. So in terms of trade location, for example, Disney is 8.5 ATR below its long-term fair value. So we mark the 270 as its long-term fair value, and then this is 8.5 ATRs below that. So we would be framing that for a reversion to the long-term mean. Conversely, those in the red, the bottom shelf, are the ones that are the most ATRs above their own RL270. So Boeing and Verizon are over 4.5 ATRs in front of or above their long-term fair value. So these tend to be on the bottom shelf, the ones that are overheated, which is why they're in the red, and this reflects that they have been leading the way lately. So Boeing, Verizon, Caterpillar, Visa, and Procter & Gamble as an example. The daily squeezes, these are the symbols that are postured for a large intraday pop. Their range on Friday was narrow compared to their 30-period average range. And the maximum intraday move, the range stat, divided by our risk level, is greater than 2. So this sets the possibility of green and red zone trading, that if you get a pop outside of yesterday's boundaries, then a range stat move is more likely, and then these are well postured to reward you on that kind of one-day pop. So this is a form of swing trading one day at a time based on these trade location and relative volatility indicators. Taking a look at the z-scores of our 10, 30, and 90 regression lines that have been normalized based on the z. You can see that the 10 period is up near its 1.0 sigma, and that's the place where it's rolled over in the last 180 days. This is about as steeply up as it has been able to get. And so this would be a natural place at the top of the river for the market to roll over. And you can see the constraining effect that the top of that river has had in previous reversions. The 30, on the other hand, has sold off pretty well and has only started to hook back up. So, in fact, this does represent a swing opportunity of some magnitude. If you look at the nearest neighbors, so after some support at the bottom of the river and then testing the top, in fact, it gained some, and it gained some. So there is reason to believe that there's some upside to this. However, you'll notice that this 249, 250 has really been a strong barrier in the past 6 months. So you combine this tightening channel and reduced volatility and recent all-time highs acting as a constraining factor, plus the geopolitical sharp adverse moves would not be surprising, back to 240 and even as much as 230. So this is a time that really favors the shorter term holders. So that's everything I want to cover on this week's report. Take good care, and we will see you in the chat room. Keep your risk measured and your powder dry. Oh, P.S. Let me also say that the hard drives for the live trading Kansas City workshops were shipped this week, so if you were on that distribution list, you should be seeing them. I have also been able to upload about 90 gigs worth of video data, as well as some reference files to Dropbox. And so, since that reduces my cost, I can offer the sale price for that workshop at $1,000 for an additional month. For those of you who might be interested in getting on board with those very high definition case study files. There's over 100 trading case studies plus a dozen high quality research presentations and crosstalk among the traders who were in Kansas City this summer, and I can strongly recommend the package to you. If you're interested in a package deal for the 2016 case studies, I would be willing to tolerate that idea as well. Also delivered through Dropbox for your convenience. I've added a bunch of additional bonus material for folks interested in the packages to recognize your patience. So this is Ken at Tortoise Capital. Keep your risk measured and your powder dry.